Today we are going to talk about the economy, everything going on with inflation, the supply chain being massively constrained, what this means moving forward. Are we going to see crashes in the market, etc.? And there is not a better person to ask than my partner, Jerry Sanada. So we are going to go through some questions that can help educate us to, hopefully plan and prepare for the next years ahead of us. So I guess your view right now in the economy, if you were to kind of rate its, what would you say, healthiness on a scale to 1 to 10, what would you say we're at right now?
That's a hard question to answer, to assign a number to it. I mean, you've got a lot of mixed signals, going on. You've got, as everybody knows, you've got constraints, supply chain constraints, and you've got, labor shortages and, things that are, fairly negative for the economy that are going to be significant headwinds as we try and work through this. But at the same time, businesses are adapting. People are spending money. You look at things like the problems in the ports, and people are buying stuff. And a lot more than they have in the past, even pre-COVID. So there's overall, I would say the economy is relatively healthy, but it's kind of like saying I'm healthy with a broken leg, So that there's some real issues that the economy has to work through, still, and those are pretty obvious to see. But overall, it looks like we're doing well considering the circumstances.
Okay. So big thing that we're hearing about, and I think everybody's feeling, is inflation. This has been a big topic for us over the last 12 months. How do you feel as far as inflation goes right now? We were having a conversation a few months ago, about 6 months ago, about it being temporary or transitory, and a lot of people are looking at going, no, it's going to be here for longer than we thought. Your view on that?
Yeah, when we talked about it, I don't remember how long ago it was, maybe 6 months or so. I stated the opinion that the risks were to the upside. I think the Federal Reserve was right in their assessment, probably, but there were some real risks that inflation could prove to be a little bit greater of a problem than they anticipated, and potentially significantly greater. Right now, we're kind of on that greater than anticipated, but not significantly greater, and the mindset is it is still a transitory thing, but that word is really widely misunderstood, so let me explain that. When we talk about it being transitory, we're talking about the rate of inflation. So, prices have increased fairly significantly, relative to our, historical experience over the last 12 months. We're not talking about those prices coming back down, okay? We're just talking about them not continuing to rise at the same rate that they have looking forward. So, when we say transitory, that's what we mean. And I think that's still a reasonable expectation. The basis for that is, coming into this environment, we had a lot of deflationary pressures on the economy that were still in place, and COVID certainly exacerbated that problem. And the things that we're dealing with now are largely a function of having shut down the economy. So, when you do that, the economy is not meant to be shut down. It's kind of like, a race car engine. It runs, it's a fine-tuned machine, and it will run at a very high level of performance. But if you turn it off, it might not come back on smoothly. And that's what we're dealing with. You have, the labor shortage, for example. You have pre-COVID, going back to 2000, we had a labor participation rate of about 67, just under 67%. And that measures the number of adults in the population that are participating in the workforce, either employed or seeking employment. That had dropped, post 2000 down to it was about 64% pre-COVID. We're below 62% right now. That doesn't sound like a big difference, but that's more than 5 million people that have not gone back into the workforce. That's a big number. And so when we talk about labor shortages, there's a whole lot of companies that are trying to get back to where they were pre-COVID. There's just not the people willing to work that are willing and able to work to actually achieve that. And so that's had actually a fairly significant inflation influence in that people still have the money to spend, but we don't have the production capacity. So on the supply side, you end up with a reduced amount of things to buy. Well, you still have the same amount of money. We still want the same things. Well, who's going to pay more? Yeah. And so, meanwhile, companies, a lot of people look at it and say, "Oh, those greedy companies." Well, their costs are rising, so they have to charge more just to survive. And so, it's a challenging environment. And the risk that we saw when we talked about this before is some of these influences, once they start gaining momentum, if they persist for too long, they can start to run wild. And inflation expectations is one of the things that we look at to kind of measure where are we at in that. And it's rising, and that's a little bit troubling. But at least for right now, we're certainly not past the point of no return. Sort of consensus is, as we look into 2022, inflation stays high for a little while we continue to kind of work through some of these problems. But as childcare is starting to reopen and kids are going back to school, and some of the other influences that may have been keeping people out of the workforce, if they start coming back, we start going back to some of our previous consumption patterns. If those things happen, then maybe it works out a little bit, kind of on schedule. But there's still always the risk that that doesn't happen.
Okay, so this is a perfect segue into this next question. There's a tweet going like absolutely viral a few weeks ago from the White House talking about inflation being a high class or a rich people problem. First off, can you answer who inflation affects?
Yeah, I think that was kind of we'll say insensitive comment. I think everybody has to buy food.
Yeah.
If the prices of that go up, it's rich people aren't the only ones who eat. So, I think that
when inflation starts rising at the rate it does right now, who feels it the most?
That's a hard question to answer. And there were studies that I'm sure that when the White House made those comments, hopefully it was based on some of the research, but there were studies in the past that that tried to answer that question and said, oh, okay, it looks like the rich are relatively more influenced than than everybody else. The hard thing about inflation is you're talking about statistics, okay? And statistics are trying to take a very large amount of data and collapse it down to something understandable. And you can think of it like taking a snapshot, or a picture of a thing. If you wanted to understand a horse and you looked at a picture of a horse, from a front profile, that picture's true, okay? It's a true picture of the horse, but that's not nearly enough information to actually understand it. Continuing with that example, you might be misled into thinking a horse is a round creature that walks on two legs. You need other perspectives on the data, and so when you look at an analysis, whether it's inflation or any set of statistics, you really need to look for multiple analyses looking at the data from different angles. So, an analysis that says, inflation is relatively more impactful on the rich is probably looking at things like a period where inflation is relatively limited in its impact to things like college education and asset prices, specifically high-priced assets, like nice homes and luxury goods. And that was kind of the environment we've been in for the last 20 years, where inflation existed. It just didn't really show up in consumer prices, the things that most people typically buy. And the CPI index, is taking a look at the prices of a basket of goods that's indexed based on sort of what the average consumer in an urban market buys on a daily basis. Well, that's not what necessarily what a rich person is buying. Their purchase pattern might be a little bit different, and so if you're looking at that set of data over the last 20 years, that can lead you to believe that. But that's not what we're dealing with right now. Right now we're dealing with a very different type of inflation that is very broad-based, and it's impacting the things that everyone is buying. Again, food and energy being an example. So I don't think that I can't answer the question of who's relatively more impacted, but given that it's the things that everyone's buying, I would say the people with relatively less discretionary income are probably feeling it more.
Yeah, and I think to put maybe more context on it, when I say impacted, I kind of mean impacted in ways that it really matters, right? Like you're talking about like buying food or surviving, right? If the cost of goods become more expensive, I have the money to pay for that. But if all of your money goes towards the things you absolutely need and those prices rise, what do? Right? So I understand like the conversation of like asset inflation, and that's something that the rich can complain about that, maybe doesn't impact the poor, but in an environment like this, right? And that type of message, when I went and looked at it, I went, how are you not involved in this moment that everybody's involved in? That makes zero sense for what is happening right now,
I'd have to agree. I don't have, the research studies or anything to cite to support that, but it sure seems like that's the situation.
So moving on to let's go into real estate for a second, because this is something that we hear a lot on social media, that the real estate market's going to crash, and I'm not going to invest until it crashes. Can you kind of break down the challenge behind that thinking of trying to time the market?
Yeah, we hear that statement in a lot of different varieties. My own son the other day was telling me that he wants to start investing because he's finally got his first job, and so he's saving some money, and he wants to start investing, but he wants to wait for the market to get a little bit calmed down and become stable before he does. And I asked him the question, when exactly is that? Tell you what, go back and do a little bit of homework, look at the history of the market, and tell me, when has that ever happened in history? It hasn't. The markets are inherently an unstable. If you're looking at daily prices, they never stabilize and stay flat, or just become linear. The structure of the market is stable, but in that structure, prices are going to be volatile. And trying to predict what is going to happen tomorrow, when we look out over very long time periods, you kind of have this, we think of it like a regression to the mean. You've got some sort of a base level of value, or what we would refer to as an intrinsic value of a thing. And on any given day, the market is it's a big auction. Okay, people are coming to the market and looking to buy, and a transaction happens to the highest bidder. Well, on any given day, someone might be willing to way overpay for a thing. And on some days, people are relatively pessimistic, and maybe things are selling for significantly less than they're worth. But over time, those prices kind of go up and down, but revolve around sort of that intrinsic value. So we can look at that intrinsic value and say, okay, 10 years out, what's this thing really worth? And what do we think we're going to make overall? But trying to pick what those points are going to look like, or identify where exactly are we, are things going to go down next or up next? I don't know anybody who can do that.
So what I gathered from that is it's really hard to know when the high or the lows are going to be, and if you're waiting for a crash all the time in between, you might be missing out on return. And then, I guess I should say it this way, is the better way to look at it, how can I be in the market for the long haul? And how can I make money regardless of cycles? Is that the best way to look at it?
Yeah, and I mean, there's a lot of great literature out there on the subject of, the cost of waiting, and okay, if you were to make the mistake of not investing and waiting, what does that result look like, versus if you made an investment consistently, let's say in the stock market every single year, and let's say you pick the worst day of every single year to make that investment. You pay the absolute highest price. What's that result look like? And invariably, that's better than not being invested. Even if you started in 1929 and the very next year, the next day the market crashed. That market crash, we're talking, we haven't experienced anything like that. Today's market crash is pale in comparison. So, being invested is, an important thing. And, when trying to make the decision of when to invest, the answer is pretty much always now. No matter what you think, there's never a time when you can look forward and not see a threat on the horizon. And in fact, the bigger those threats are and the more scared everyone around you is, the better the time is to be investing. So, it's the times when, everybody's wildly optimistic and going, an example, in 2000, it was 2007. I was at a conference where they were talking about the Goldilocks economy, not too hot, not too cold, just right. Everything is perfect. Alarms started going off in my head, and I wish I had reacted more to that. But, anytime people are, you have a consensus that everything is golden, that's the time to start getting worried. When things are scary, that's the time to be aggressive and start getting your money deployed.
Oh, that's a really good point. And I think it is important to note, because I experienced this in the 2008 financial crisis. It was terrifying. It was so scary. I remember so 2008, we started St. Archer 2012. Our biggest concern was still recession. I remember that was like a big thing that we pitched when we were raising money. Alcohol does really well during recessions because everybody still felt it and was scared 3 years later. So I think it's good to remember that even though we know the opportunity is in those moments, that doesn't mean it's easy. It's really, really hard in those moments. The times where it's good, it actually feels better to invest, right?
Yeah, but you're going to get a worse result. Yeah. Even bringing it a little bit closer, because a lot of people coming into the market now don't have any memory of 2007, 2008. But, just last year, okay, I remember in March, going, okay, COVID, that could be a game changer. I mentioned to you once in one of our conversations, I don't worry about economic growth. Again, looking out over the long term, the things that drive economic growth are population growth and productivity growth. As long as those two are expected and reasonable to expect, you don't have to worry about economic growth. It's going to happen. Maybe not next year. You're going to have the bumps along the way, but long term the economy will grow. Well, COVID, okay, when we were looking at data that said, hey, you might have, I remember seeing numbers like, 5% of the population dying, it was one of the more pessimistic outlooks. And, you get something like that, well, okay, that could be a game changer. So, even I had moments where I was watching the media going, this is a little scary, okay? And the market moved quite significantly lower as a result of that. But here we are a year later. Things didn't get less scary. Okay, as we were going through, the market didn't wait for things to get good again to move higher. Here we are. We haven't recovered yet, and in terms of the economy's not all right yet. But where's the market? Okay, it not only recovered those losses, it moved way, way higher. The market doesn't wait for things to get good. Yeah. The market just waits for the fear to relax. Okay, it's when the last panic seller executes his trade is when the market starts its march higher. And so don't be that guy.
Yeah, that's a really
be the one that's ready to buy in those moments. But again, looking forward, we can't predict when those things are going to happen. So next year we could see another variant that throws everything into turmoil again, and the economy goes into or hits the skids, and we end up with another severe decline, or maybe we work through these problems and we never see these kinds of prices again. You might see. I remember 1993. There was an associate of ours who was retiring, and he decided he wanted to take all of his money out of the market because the Dow Jones could not possibly be worth 3,000. Okay, that was just an insane valuation in his mind, and he was certain that the market was going to crash, and then he would get back in, and then he would stay invested. Well, the market never saw 3,000 again. Okay, it proceeded up to 10,000 and beyond before it finally corrected. So you just don't know what's going to happen. But the safe assumption, I believe, is that investments generally are going to do well if you're looking out over a long time horizon. Best thing you can do is invest and stay invested.
So we were talking the other day about the real estate market and the crash, kind of like the question I just asked you about people waiting for the market to crash before they invest. You see a lot in real estate as well. And there's this big conversation going back and forth about the market crashing like it did in 2008. And when we were at lunch, we were talking, and you kind of said something along the lines of, the housing market isn't good. No, it's not that it can't ever, but it's not going to crash like it did in the past. And you looked at me, you're like, 2008 wasn't even that bad. Now, for me, that was the one that I experienced. The one prior was, what, late 90s, was it?
Well, there's been some bumps along the way.
So I don't remember any of those, right? Like the dot-com bubble, even though that's not real estate, I wasn't paying attention then. 2008 is what I remember. Can you give some context on the real estate market, how it's corrected in the past, and what you were meaning by that statement?
Yeah, so 2008 was different, and we'll back up to where the real estate market was when I started in this business in the early 90s. You had 1990 was kind of a approaching the end of a very bad cycle for real estate. Typically in the past, the credit cycle and real estate values were very highly or I should say, real estate prices were very highly influenced by credit. Still are. But what would happen in the past is you get, things are going well, like they have been, over the last few years. People get optimistic. You get all the flippers and all of the people who are trying to maximize their leverage and to get those better returns, and things just keep on getting a little less rational and a little higher risk and a little more leveraged until finally you get to that tipping point where foreclosures start to happen. People start to, there's not enough margin left and something goes wrong, which it always does, and you don't have enough, the credit underwriting wasn't robust enough, I guess we'll say, where people are, on loans that, they can't make it through. And so foreclosures start to happen, and banks themselves are very highly leveraged. A foreclosure is a terrible situation for a bank. And so when they start having this problem of, okay, we've got a loan that we have to foreclose, and oh shoot, now we have another one, their first reaction is slam on the brakes. Okay, they don't do anything gentle. Okay, when they hit the brakes, they hit it hard, and they just stop lending and say, okay, let's figure out how to fix this problem before we do the next loan. Well, one bank does it, then another bank does it, and before you know it, credit has dried up. The buy side of the market disappears, and now there's no bid. Okay, and so the guys who are in trouble are having to sell into a market where there's no buyers, prices crash. That gets further compounded when the bank regulators come in and look at the banks and go, okay, you've got now troubled assets on your balance sheet. Get rid of them now, okay? And the banks would be put into forced liquidations in order to keep from being forced into a takeover, being swallowed up by another bank. So faced with the decision of, do I keep my paycheck or do I sell that property for whatever I can get for it? They sell, and so that increases the supply, drives prices further off a cliff, and so that was the real estate cycle we used to experience. 2008, they made a change, and the Federal Reserve, looked at the banks and said, "Okay, this is bad. We've got a large amount of foreclosures, and we've seen what this does, and for the sake of not taking down the entire system, they looked at the banks and said, we're going to let you try something different this time. You don't have to sell everything. Take your time, think things through, review every loan, see if a workout makes sense, give a forbearance if you need to, foreclose if you have to, but slow down, think it through, be smart through this process." That made all the difference, okay? And so the big crash and the blood in the streets that everybody was predicting didn't happen, okay? Prices went down, yes, but not like they did in previous cycles. And I remember, looking at, paying 40 cents on the dollar, for real estate. Well, that just didn't happen, So
then that's when we saw the low not be as low as it should have been, but also the recovery took a little bit longer to come back from, correct?
Yeah, exactly, because the banks now spent a whole lot longer working through those loans, whereas before it would be, okay, fall off a cliff, and now there's opportunity there, and so people come back in, recapitalize, and things start going again, but you're just starting from way down here. This time, okay, we're starting from here, but because everything hasn't worked out yet, the banks aren't really fully lending, and so the economy's kind of on life support for an extended period of time. Which one's better? That's for the politicians to decide. But the result for real estate investors is that we didn't see the kinds of crashes that we saw before. There wasn't the no-brainer type level of buying opportunities that there were in previous cycles, and where there were opportunities, they were far more narrow in scope. So it was a lot harder to find them. So looking forward,
what is your idea for the next 10 years? Like, I get this is a prediction or speculative. Do not take this as this is what's going to happen. But if you were to look at the real estate market for the next 10 years, what would you guess you're going to see?
I think it's more of the same. Okay, I think the from a policy standpoint, I think the belief is that this experiment, if you will, in 2008, was a success, and between that and new banking rules that came after to try and again further reduce the probability of that environment ever happening, you have Basel III and other banking rules that came into place. The frequency and the magnitude of those problems should be lower, and so all of that, I think, is generally good from a real estate investor's perspective. If you're the guy who wants to act like a hedge fund and go out and find that deep discount opportunity, it's not so good for that guy. Okay, those are going to be a lot harder to find. But for the average real estate investor that's looking for cash flow and wants to know that when my mortgage comes due for a balloon payment, I'm going to be able to refi and not have as much risk from the financing environment, I think that's very good news. And well, shoot, an example of that, 2007, one of our blue chip, high cash flow, stable, seasoned properties, the mortgage came due, and it just happened to be a really, really inopportune time. Trying to get a loan was, extremely difficult. There were very few lenders that were willing to lend, and those who were charging a very high premium. Our interest rate went up by almost 300 basis points. Well, that hurts. You're stuck paying a higher interest rate. Your cash flow gets cut for a relatively long time. So, that type of a scenario, the policies are kind of geared towards getting better at reducing the magnitude of those problems. So for investors like us, where we want cash flow, we want good long-term opportunities, I think that the policies are probably generally a beneficial thing, and I think it's generally stabilized the real estate market. So there'll still be ups and downs. There'll still be situations where people get a little bit overly optimistic, and regulation is it's not a precision rifle, it's a shotgun. Okay, there's going to be things that slip through, and there's going to be unintended consequences, and people have a way of taking even good regulations and figuring out how to work around them. So there'll still be those scenarios where things get overheated, and or opportunities will be out there. But if you're waiting for them to get invested, you're not going to find, I don't think, the types of really, really deep discounts, at least not widespread, like we saw before.
Thank you guys for watching. Now, we do get a lot of comments asking for more Jerry. Jerry's building up the fan base on social. If you have questions specifically for him, leave them in the comments, and we'll do a whole thing. Ask Jerry from, the watcher's standpoint. Thank you guys. We hope this helped, and we'll see you guys next week.